So welcome to Class 6, September 10th. Today we'll be doing really what's very important, especially if you're going to interview with this industry, is understand what are those products they sell. So in last class we got into life insurance. We'll do life insurance, then annuities, then health insurance, then a few other products like disability. But right now we're in the middle of life insurance. What are those main products the insurance industry sells? And then we'll get into the debate. A big question on the first exam is term insurance versus permanent insurance, and I'll give you a few angles you can take to address that. It's an important issue, and it's still pretty hotly debated in the industry even to this day. So moving on to page 21 of the class notes, let's get into the types of insurance. So there's two main types. There's term insurance and there's permanent insurance. So let's start with term. Term's the simplest of the types of life insurance. So term is for some set period of time. It's stated in the policy. If we were having a live class, I'd be asking you to see who could think of the shortest term policy they can possibly think of. And some say, well, 1 year, 1 month, 1 week, 1 day. The shortest policy I can think of might be 40 minutes, because the shortest life insurance I can think of is buying insurance for an airplane ride. So if you were to take a plane ride from San Antonio to Dallas, I don't know if that's 40 minutes, or San Antonio to Houston, you can buy flight insurance, flight life insurance. So if the plane crashes, it will pay for that. It's an insurance where everybody pays the exact same amount because they don't have to worry about how healthy you are. It's unlikely you get in on the plane and you're going to die next 40 minutes from a heart attack or anything else. Even if you're unhealthy, it's unlikely. So everyone pays the same rate, doesn't matter about age. That's the shortest you can possibly have. The longest term usually is 30 years, and I'll show you an example of a 30-year term. Once you get to 30 years, you're getting pretty close to whole life anyway, so you might as well just buy a whole life policy. So 30 years is usually the longest. So we're going to ignore flight insurance. I used to see those kiosks in the airport. I haven't seen one in a while. I don't know if they're still there, but you could, in the past at least, buy flight insurance at the airport. So you were covered if you didn't have insurance. You're worried about the flight for some reason. It would be there. I don't know what the pricing is. I assume it's extremely cheap, but I don't know what companies sell this. I've never worked for a company that sold it. I'm sure a life insurance company is selling it at the airport. Be interesting to know what kind of claims. I would assume most years they have 0 claims. So that'd be interesting. Be an interesting research to do. But we'll start a little bit longer than that. We'll do renewable term, which is a 1-year policy. We talked a little bit about this in the previous class when we looked at the different types of premium payment plans. So renewable term, it's guaranteed right to renew. So every year you can renew, and they don't do a health exam. So you can be in really bad health and you can renew, but you'll get a rate for the general population or for their group of insureds. One thing I will say is, as you get further and further in renewable term, especially in much later years, usually the insurance starts getting so expensive that the only people who stay in the policy are the sickest ones, those who know for sure they're going to die. And so what happens with these policies is the rates jump even more, because insurance companies know the last ones renewing, the last ones in the group are the least healthy. The healthiest people, they can't take the really high rates, and so it tends to anti-select against itself, because the only people who really want to stay in it that much longer are only the least healthy one. Now they don't charge them more because they're unhealthy. They can only charge based on the entire group, but if they know the entire group itself would become less healthy, even though they don't know the health of the individual insured, but they know and historically that as people renew this, the further they renew, the more likely they are to be unhealthy. They can put that into the pricing. We will talk quite a bit about level term. Level term is my favorite. I really do think it makes the most sense for most people. It's still not as popular as whole life, but it makes a lot more sense to me for most people. So you have some term, maybe 10 years is probably the most popular, but 10 years, 20 years, 30 years used to be offered. The accounting standards changed for 30 years. You can buy 30-year term, but the insurance company technically can't guarantee you that they won't change their rates for 30 years. They may tell you that they have no plans of changing the premium for 30 years, but the rules have changed. And because of that, when you go on to the website of a life insurance company, you may only be able to go out as far as 20 years. But we'll talk a lot more about level term. Very, very great product. And we'll talk about why it's such a good product. Now, convertible term, usually when you get insurance from your employer, it's annual renewable term. It's A. But a lot of times, renewable term, you can convert it to whole life without proving insurability. You don't have to do a medical exam. Because of that, the conversion terms are usually really unfavorable. Usually the only people who convert are the least healthy. So it's usually not a great option, but if you want to change jobs, so you're going to lose your renewable term that your employer is providing for free, and maybe you're leaving that job because you're really unhealthy. You just don't want to keep the job, but you want to be able to support your family. You could convert that term into whole life and have insurance for the rest of your life as long as you pay the premium. The next one is industrial life, and I'm not sure industrial life is always term. It could be whole life. I stuck it under term just because I've never worked for a company that sells industrial life. It tends to be a very small part of any company's business. I've seen a few companies. We'll probably look at MetLife later, and you'll see they have a little bit of industrial life. I think with the internet, that's becoming less common, but these are policies really just to cover funeral costs, and they're set up for really low-income neighborhoods where all they want to do is make sure if the person dies, they can pay for the funeral. So they have very small face amounts. Because the face amounts are very low, they have very low premiums. In fact, the premiums may be weekly, which makes the premiums look much smaller. Now, the insurance looks cheap because you're not getting much insurance and you're paying the premiums more frequently. But when you really look at it compared to other insurance, it's actually quite expensive relative to what you're getting. So most people are probably better off just buying a small regular term policy, unless the family's worried. I can't say in the last part that the family won't spend the industrial life on the insurance cost, on the funeral costs. I'm not sure legally if you have industrial life, if that forces your family only to spend that money on funeral costs. So you still may be in trouble. But there are ways to control that. You're probably better off just buying a good, cheap, level term, 10-year level term policy. Another special type of life insurance, which I have seen quite a bit of, I was on the board of a credit union that did a lot of auto loans, and so credit life insurance is pretty popular. It's a very unusual insurance, because it's specifically to a piece of debt. So it says if you die, it will pay off this loan, which means it's actually, if you look at this sub bullet, it's actually decreasing term because it goes down as the loan amount pays off. It's usually sold on a group basis, which means it's usually a single premium policy. You usually pay one premium at the time that you borrow the money, and it covers you until the loan's paid off. Once the loan's paid off, you have no coverage. Here again, you're usually better off buying regular term insurance. These policies are ridiculously expensive, at least the ones I've seen. Maybe there's a few that aren't too bad, but usually, if you have a $30,000 car mortgage, or a car loan, you'll probably find that if it's a 7-year car loan and you want to insure it, you're probably better off buying $30,000 a 10-year level term. You probably have a lower premium, and then it won't be decreasing term. It's possible it's a higher premium, but it's a higher premium because it's not decreasing term. So you're probably better off just buying regular level term. The other thing I don't like about credit life is it will be used to pay off the debt. That's the way it's set up. Well, let's say you have a 5% mortgage. So let's say you're buying credit life on your mortgage. You have a 5% mortgage, and interest rates are currently 9% when you die. Your family's better off getting the money for the mortgage and investing it and just keep paying the mortgage payment on the 5% mortgage rather than being forced to pay off a 5% mortgage when they could make 9% elsewhere. So to me, it's tying the hands of the beneficiary. The real beneficiary here is the lender. Lenders love this, obviously, because it makes sure that their loans will be paid off if you die. You know, if someone dies, you can't force the beneficiaries to pay off the loan. You know, you do have access to the corpus of the person's whatever they have left in assets, but if they have insufficient funds and they die a pauper, then yeah, that loan will default. And so credit life is really protecting the bank more than anyone else. All right, so there's our term life insurance. So let's move to number 2, which is whole life or permanent life insurance. This product is still sold, and it's very popular, but you rarely see it pushed hard by insurance companies, mainly because the agents usually make more commissions off of other products. I'll talk about a product my parents purchased, which they should have bought just regular whole life. Looking at what they want to accomplish, this would have been the best product for them. But we'll actually even compare some premiums so you can see the difference. But for ordinary whole life, the premium is fixed for the entire life until the person dies, or until age 100, depending now. They may go out a little further now. So the insurance lasts your entire life, and that's what I'm looking at what my parents are going through right now. And when you see their situation, you'll see why whole life would have been a far better product. So I think it's still sold a lot. It's very simple, very easy to understand. It does have a cash value, which means if you give up on the insurance before you die, you'll get some money back, and we'll look at that here in a little bit. We'll price some ordinary whole life so you can see how it works. I think it's a perfectly good product that's just not heavily pushed by the industry because of the agents and the conflict of interest on the commissions. Limit pay whole life is essentially the same thing. We saw that earlier when we looked at the graphs of the premium payments. But here you might say, you know, I want to pay premiums at a fixed rate. I want insurance for my entire life, but I don't want to have to pay life insurance premiums after I retire. So I just want to pay the premiums until I hit 65, and then I just have insurance coverage the rest of my life, and I have cash value, and the cash value will grow even after you stop paying premiums. But then if you die anytime after you retire, you'll get insurance even though you stop paying premiums at age 65. So that's not a bad product either. The premiums will be higher, and remember the graph, they're not ridiculously higher, but they are higher. All right, so we talked about the 2 disintermediations. So this is really important here. This sets up the next several products. I probably should have separated this off. But the first disintermediation was when interest rates got really high. So if you look at 1979, the typical whole life policy, maybe you had a $10,000 policy with $20,000 in cash value. The life insurance company on the whole life was paying you 3%. And I kid you not, you could get CDs at 18%. So what people were doing was borrowing their cash value from the insurance company to $20,000. They're paying 3% on the borrowed money, and they're investing at 18% in the CD. If they died, they would have gotten $100,000 minus the cash value because they borrowed the cash value. So they would have gotten $80,000, and their family would have had $20,000 invested at 18%. So the family would have been better off. So life insurers see cash leaving and going to the banks. That's that disintermediation. The second issue was the stock markets in the 80s. So we've talked through this, nothing new here. So these 2 events said the life insurance, we have to move away from these regular, boring whole life policies. We got to create something new and exciting. And the first thing they created was universal life. I used to like universal life. I was never as big of a fan of it as I am for whole life. Now dealing with a few people who had universal life, I no longer am a big fan of this product. I think it's still too complicated. Remember when we talked about the ethics of life insurance, we got into this issue of complexity. The products are getting more complex. So universal life is the first foray into those really complex products. Now universal life did not solve this intermediation, But what it did is it let companies start all over from scratch with new portfolios at the highest and higher interest rates. So essentially what they're trying to do is someone was going to disintermediate. What they wanted them to do is disintermediate within the life insurance industry. So get out of your whole life and move it over to universal life, so that at least cash wasn't leaving the building. They'd still be worse off because they'd have to pay a much higher rate on the universal life than they would have been paying on the whole life, but they'd rather people reinvest with them in universal life and paying them 10% on that policy than have them take all of the money out and move to a bank. The premiums, the cash value, the level of protection can be adjusted up or down, so there's some flexibility there. The rates, and this is a huge one, highlighting this in your notes, this particular point, point number 5, this is huge. The rates credited on the cash value, unlike whole life, the rates credited on the cash value are very competitive. They try to be current. And these rates can move. That's a big difference between whole life and universal life. Whole life, you have a fixed premium for the entire rest of your life, and so and the rates you're getting are not well discussed, so it's pretty straightforward. You're given, everything's just guaranteed. But with universal life, the rate they pay you on your cash value changes every month depending on competitive pressures and what interest rates are doing. This is a big deal. We'll talk about vanishing premiums here in a second, and why the fall in interest rates have made these products particularly problemsome for a lot of insured and for a lot of insurance companies. Now here's the big thing. When you see the word universal, you should automatically equate that with this word unbundled. Universal life insurance was the first unbundled life insurance product sold by the market. By unbundled, what it meant was the insurance and the savings elements, the cash value and the life insurance were separated. You only had to pay the insurance to cover the cost of, you only had to pay a premium. You only had to pay a premium to cover the cost of insurance, the COI. The cash value part, the savings element part, you did not have to pay that part of the premium if you did not want to. So unbundled. With whole life, you have no choice. There's one premium and you have to pay it every month. Some of that is for the savings part to go into the cash value, and some of that is for the insurance, covering your insurance rates. The COA is going to go up as you age, but you hope that the premium you're paying, the savings element, will be more than large enough to cover the cost of insurance, plus what you're earning on your cash value, that eventually you'll have more than enough money to cover the cost of insurance for the rest of your life. Hopefully. We'll see that it didn't quite work like that. All right, another complexity with universal life is the structure of the death benefits. The universal life A, which is probably the more popular type, the death benefit is the same your whole life, no matter what. It doesn't change, doesn't matter what the cash value is. So as the cash value grows, you're actually insuring yourself more, and the insurance company is insuring you less. For universal B, what you get paid if you died is the death benefit plus your cash value. So there the death benefit stays the same, and your beneficiaries will also get your cash value. So if you have a $100,000 policy and a $30,000 cash value, if you die, your beneficiaries under on level B, on Universal Life B, will get $130,000. So $100,000 death benefits plus your cash value. Under A, they just get the $100,000 no matter what your cash value is. Obviously, B is going to be more expensive than A and can get really expensive later in life, no question. I think A is the more popular product because of that. On the policy loans, again, it gets more complicated, where what insurance companies are doing on universal life, if you take a policy loan, they'll reduce what rate they're paying you, and they actually charge you a higher rate for what you borrow. So they're trying to discourage people from borrowing against their own policies. So that's another change. And this gets back on number 5. Back here on number 5. Sorry, I said the rates have to be competitive. So when we come here to number 9, another very, very important thing is what we discover through universal life. And boy, I discovered this in my career working for a life insurance company. Is that these products are sold, are marketed based on the crediting rate, the rate that they're paying to the cash value. Whole life didn't do that because the crediting rate was just in the policy fixed and wasn't all that competitive to begin with. We'll talk some about that when we talk about A.L. Williams. Wasn't all that competitive. And so they didn't want to advertise it. Once Universal Life came out, I used to see these small marketing brochures insurance companies would use to sell Universal Life. And usually the front of that brochure was this huge number, like 6%, 7%. And it was a crediting rate. Well, so now we're getting into something that is extremely important, very closely related to the ethical issues we're talking about. Most insurance on Universal Life is sold on that crediting rate and completely ignores the cost of insurance and the expense charge. Well, that if all people are looking at is that crediting rate, they can buy some really horrible products. And I'll give you an example here pretty soon. But it's possible a company that's paying the best crediting rates also charges the highest cost of insurance and also has the highest expense charge, which means, now the expense charge comes out of the crediting rate, so you should notice those too, but the cost of insurance is not part of the crediting rate. So it's possible they're paying you a higher rate on your cash value, but they're charging you a much higher cost of insurance. So is it better or is it worse? It's just a complication. And I'm going to argue as we get more complicated, these products become almost impossible to compare. And we'll see that definitely here. So that's a major change. And really, I think it's an indication when the life insurance industry switched from selling insurance to being asset gatherers, being investors, when their glossies for their marketing products had huge interest rates on the front of them and nothing about the life insurance. That's when the industry really changed. And it's also when the agents, because they got better commissions, these were very profitable products. So yeah, the insurance industry started pushing those. So just under that bullet, let's continue with that discussion. Still under Universal Life, the advertising for whole life is just how much coverage you get and what the premium is. The advertising for Universal Life is dominated by the crediting rate. No mention of COI or other expenses. And so let me talk this Vanishing Premium. You can look this up. You can see large insurers like MetLife and Prudential, just pretty much any company selling Universal Life had some huge lawsuits in the 2000s, late 90s. The way these were sold, and boy, I'm dealing with exactly this issue with a policy for my parents. The way these are sold was they tell people, here's your premium. If you pay this premium, here's a coverage you should have. However, if interest rates keep doing what they're doing, there comes a time where your cash value is so large that you can just stop paying your premiums and you'll have insurance for the rest of your life. That's what they call vanishing premiums. And that was true if interest rates stayed high, but they didn't. Interest rates fell dramatically. And while people were discovering, and I'll show you with my parents' product, this was a huge issue. Even people that were paying the full premium, both the cash value and the cost of insurance, what they discovered was the cash value was not nearly large enough to cover the cost of insurance, and they were seeing their premiums shoot up dramatically 25, 30 years later. So let me tell you, with my parents' product, they had exactly this happen. They were paying a premium of $350 a month. That premium today is $1,520. This is a product that was sold as permanent insurance. My parents were told that as long as they paid $350 a month, they'd have insurance for the rest of their life. They forgot to read the fine print that said, unless interest rates fall, if interest rates fall, your premium could go up fivefold. And it's going to go up every year that the person whose life is insured, as they age, that premium will jump and jump and jump. You would think we would have canceled this policy. However, the life that is being insured, that person is very poor health, so we don't want to cancel it. It's put us in this horrible situation of wanting this person to live for a long, long time, but at the same time, we got this insurance policy that is just killing us with the premiums. So it's a very, very difficult product. My parents would have been far better off just buying a whole life policy. They probably have, instead of $350, and I'll show you when we get the pricing, we'll compare some of these. They probably would have, instead of $350, had to pay $380 a month. But it wouldn't cover them for their entire life. They would never have to worry about that premium shooting up. Instead, they bought a policy that had $350, and then suddenly all their cash value is gone. They don't have enough in premium to cover, and suddenly their premium shoots up to $1,520. So let's just, I mentioned this before. So you got company A, its cost of insurance is $50, and they're paying you 4.2%. And that rate can change every month as interest rates change. Their loan interest rate is 4.8%. So they charge a little bit more for borrowing your own money. Company B, their cost of insurance is $75, so they're a good 50% more expensive than A, but they're paying a 7.3% rate. But then if you take a policy loan, you're going to be paying 8.9%. Which is a better product? Who knows? You'd have to run so many different scenarios. You might say, wow, this 7.3 over a long period of time, obviously that's going to take over. But remember, since these rates can change monthly, they might push universal life just at certain points at the time of the year. There's nothing legally that keeps them from taking this 7.3% and dropping it down to 4% 1 month later. That's called bait and switch. It's another ethical issue for insurance companies. Some insurance companies sell heavily to teachers. And teachers, when they get these products, they have to make the decisions in August when they come back to school. And so what a lot of life insurance companies do, they give really high rates in August. And the teachers are looking at the different products and they see that 7.3%. And so they say, oh, that's the product I'm going to buy. And then the next month, in September, October, they drop the rate down to 4%. It's legal. So that's why you really need to do a lot of research on these companies and figure out who the good guys are and who the bad guys are, because there's a lot of bad guys. So that's why I ask, is this really permanent insurance if your premium can increase dramatically? So essentially, once your cash value drops down to zero and your policy is just the cost of insurance, it's going to look exactly like annual renewable term, where your premium will just jump dramatically every year. So that I've gotten so I don't like this product. The other thing I don't like about this product is it automatically terminates at age 95. So at age 96, you just don't have any insurance at all. Another horrible part of this product. So I can't tell you how much I dislike this product, but it's worse. I'll show you a little bit later. We may save it for the time when we're doing pricing. So the insurance industry said, well, okay, that protects us from high interest rates, but what are we going to do about these high stock markets? Stock markets are taking off. People aren't buying life insurance anymore because they want to be in the stock market. And so the industry started this new product called variable life. All right, so this is real key. Remember when we saw the word universal, you think of the word unbundled. Unbundled means that the cost of insurance and the savings element are two separate premiums. You only have to pay for the cost of insurance. When you see the word variable, now you're getting into these are products that are really investments. You're investing in the stock market and other mutual funds. These are regulated by the Securities and Exchange Commission. So these are regulated both by the states and by the federal government. It's dual regulation. If you work for an insurance company in the sales department that sells these products, you'll have to be licensed by the state and get licensed to be able to sell from the federal government using NASD. So the policyholder has a lot more control now. They can decide where to put the money. It's no longer the insurance company, like Universal Life, the insurance company buying investments and passing whatever they earn on those investments on to their policyholders. Here, the policyholder says, I want to invest in a Vanguard S&P 500 index fund. Or I want to invest in a Fidelity Growth stock fund. It's their choice. They go on to Cincinnati mutual funds where they pay fees on those mutual funds. And so the SEC, there's actually a U.S. Supreme Court case. We'll get into this more later. But a U.S. Supreme Court case where a company that sells these variable products was taken to court by the U.S. federal government. The U.S. federal government said these are investments. They're not insurance. Investments are regulated by the SEC. And the Supreme Court decided with the U.S. government on that and said, yes, in fact, these policies are investments as well as insurance, so they're regulated still by the insurance industry commissioners, regulators. So, yeah, you have dual regulation. The other thing is, since the policyholder is directing how things get invested, these are no longer the life insurance company's assets. And so when we get to the accounting part of life insurers, they have what they call separate accounts. They actually move these assets off of their books and put on a separate set of books. That should protect the policyholders from the insurance company going insolvent. I don't know if it's been fully tested in court, but that's the idea. If the life insurance company goes insolvent, your assets are not really with them. Now, with universal life, the life insurer goes under, you're exposed. You have a credit risk, and that life insurance company, you'll get some protection from the state that you are in with some kind of a little bit of insurance. But if you have more of that life insurance than over the state minimum that they protect you for, then you'll lose money when that insurer goes insolvent. The argument is with variable products, if the life insurer goes under, you're protected because these are separated off into separate entities. But I don't know if that's been really tested yet, so we'll have to just see. The premium is fixed, so this is not like universal life. You have a fixed policy premium. You have to pay that premium your entire life. You do have dual fees. You have fees that the life insurance company is charging, and you also have the underlying fees of the mutual fund. Now, I was helping someone who had a product like this, really horrible product. I don't like these products. I called the insurance company she was with, and I wanted to know what the mutual fund fees were. And the lady I talked to on the phone says, "Oh, there's no fees. There's no mutual fund fees." And I said, "No, I just want to know what the management." And so I finally just said thank you and hung up and called back. I got a different person, and that person gave me the mutual fund fees. Just to point out how complicated these products are. People selling this product are so confused on these things. So if you're doing Fidelity's mutual funds, you're paying Fidelity a fund fee. They may have a special arrangement with the life insurance company where they charge a particular rate with that life insurance company, but you're paying them fees, and you also have fees that the life insurance company is charging as well. If you look at the people who are really critical of this industry, whether it's David Ramsey or Susie Orman, they hate these products because of the fees. And really about the only way you can do better with these products than if you just went out and bought the Fidelity Mutual Fund directly is tax law. Tax law, first of all your gains on this are tax deferred. And then if the person dies and gets the life insurance is tax free. So without the tax code, these products really don't make sense because you'd always be better off with a mutual fund. And then they got even more complex. They did variable universal life. So here it's variable, so you're deciding where to invest the money, but it's universal so that you have two premiums. You have one for the savings element and one for the cost of insurance. So essentially it's universal life insurance, but where you get to decide where to invest it, and the policyholder bears the risk. The next one is Endowment Life. I love Endowment Life. We'll be looking at this. It's a product that I wish the insurance industry would sell, but they do not sell. I call it longevity insurance. You'll see it when we do some practice problems for the pricing side, and you'll see why I like this so much. But Endowment Life Insurance, it's a little bit different. Let's say you buy it at age 20, and say it's a 10-year policy. So it's $100,000. So if you die between 20 and 30, you get $100,000, or your beneficiaries get $100,000. However, if you're still alive at age 30, you still get the $100,000. So you get the $100,000 where you die or live. Obviously, it's much higher premium, but before the tax code, 1984 tax code changed, it was viewed as an incredibly tax efficient policy because you're getting the face, they're considering insurance, so it's tax-free, everything's tax-free. This was like a really good way to avoid taxes. The 1984 tax code changed that and did not give that huge tax advantage. These are still very tax advantaged insurance contracts because you do get the tax deferral and you do get tax-free if you die and get the face. What you lose is the tax-free if you live and get the policy at the end. There you have to pay tax on whatever gains you had in the policy. And then the last group that we'll talk about, we're actually going to see these again when we price life insurance, are joint and survivor policies. You can have a first to die policy or a second to die policy. A first to die policy, So you have a husband and wife. You want to make sure if either dies that the one remaining has some money to be able to pay. This is real popular. I could see this with my parents where my father has a pension, but he chose the pension where that if he dies, the pension stops and my mother doesn't get anything. So what they did is they did that pension. We'll price this later. I actually want to show you how this works. So what he said is, well, if I take the pension that's just on my life, I get $5,000 a month. But if I make it a pension where it goes for both my life and my wife's life, I only get $4,300 a month. So they'll want $5,000 a month at $4,300 a month. Well, I'd rather have $5,000, but if I died and my wife doesn't have enough money, well, what if I get the policy for $5,000? What if I get the pension for $5,000 a month, but I take that $700 extra dollars to have, I take some of that, maybe I take $400 of that, and I buy a life insurance policy, and I buy a first to die policy. So when the first person dies, if it's the one who has the pension, then the pension stops. But you use a little bit of that extra pension money to buy a life insurance policy to be able to take care of the spouse that's remaining. Could also help with mortgages or education or other things. The second to die policy is it doesn't pay when the first person dies. It only pays when the second person dies, and that's really to handle estate taxes and other kind of estate planning types of items. All right, so we're well over halfway through the class. If you need a break, this would be a good place to hit pause. We're about to shift into a big topic here. So I'll pause for a second here and let you decide. Okay, so before we get into term versus perm, just a couple of minor issues to talk about here. With all of the products I showed you, universal life, variable universal life, whole life, ordinary whole life, limit pay whole life, 10-year term, 15-year term, all of them, actuaries can create anything you want to create. And we'll see that when we do the pricing. I'm going to have you price some really bizarre products. I actually think some of them are pretty good products, actually, but we'll see. Actuaries can do anything. So the question is there a market for that? So it makes sense because it's expensive to create these products because you have to file them with every state that you sell them in. So there's a lot of regulatory costs with these. So what we'll get into this, I want you to see it's really not that complicated. It's mortality tables, figuring out when people are going to die, and then it's discounted cash flows, and that's it. One other thing with life insurance, especially with whole life insurance, you can have this with term as well, but it's usually with permanent insurance. You have participating policies. So with whole life, because they're insuring you for the entire rest of your life with a fixed premium, the company's a little nervous. What happens if mortality rates shoot up? Or what if our expenses shoot up? Or what if the bond market goes crazy? So what they do with some of these policies is they charge a little extra, maybe an extra $10, $15 more than they really need. And over time, they return that to their policyholders as dividends. And they're tax-free dividends. It's like a return of premium. And these can be pretty lucrative. When I was at UTSA, I remember the presentations from the actuary who did the participating policies. And boy, he protected his policies. He wanted to make sure the company really paid the right dividend. He wanted as good of a dividend as possible so that his product would be competitive. And they took it seriously. It's like, yeah, we intentionally overcharge these customers. We owe it back to them. We should pay them back the money. So excess profits are paid back as dividends. Now, my brother sat in on a presentation from a life insurance company we're about to talk about with this term versus perm. And they showed him an article where the person writing the article said participating policies are ripoff. Anytime you have a participating product policy, you're being ripped off. I don't believe that. But their argument was really bizarre because my brother had a policy from State Farm and it was participating. It was a term policy. It was participating. It was a 10-year level term policy. And what they pointed out to them is that State Farm had never paid a dividend on that policy. And they say, see, you're getting ripped off. But what I pointed out to them was the policy my brother had from State Farm, I don't remember the numbers, but I think maybe it charged $50 a month. The exact same product that this insurance company they were working for had charged like $90 a month. And they were saying my brother was getting ripped off because his company wasn't paying him dividends, but his premium was $40 cheaper. So, you know, it's true State Farm may never pay a dividend on that policy, but they could. But even if they never did, he was paying $40 less for the same insurance than he would have paid for this other company. But they were telling them that with a straight face. And boy, it was just really unethical sales practices. I wish I had a video of that. I don't know if they would have let me do that, but they said things that I really think were borderline illegal because it was very deceptive. It was several things that they said. But that was one of them, that my brother's getting ripped off because State Farm's policy was a permanent policy. But boy, I told him, you're a lot better off. You're paying a lot less in premiums. But the downside of participating policies is this adds one more complexity. It makes comparison shopping very, very difficult. So let's talk about comparison shopping. You have two products, you need to compare them. Well, I'll just tell you now, if it's a whole life policy and a universal life policy, forget it. There's no way to compare them. But let's say you have two whole life policies and you're trying to decide which is the better product. So there are two ways to compare them, and these are actually pretty good approaches, especially the second one. The interest adjusted net surrender cost index is a really good way to compare policies. And the traditional net approach really, to me, is not that valuable because it doesn't take into consideration the time value of money. So let's do this. We're gonna do a policy as if it's $1,000. We'll price it for $1,000 face. That's usually what happens. So if you have $100,000 policies, that's 100 units of $1,000 in premium you have, and coverage that you have. So let's look at this example. Let's start with the traditional net approach, cost approach. I don't like this approach. If I ask this on the exam, I will not give you the traditional net cost approach. I just don't like it. But what we'll do is we'll look at 3 years and 20 years. We'll look at how many accumulated dividends you've got on this product. By the end of year 3, you only had $196 in premiums. But after 20 years, you had $10,000 in premiums. So that's pretty good. And a $100,000 policy, you got $10,000 back from the insurance company. Your cash value at the end of 20 years was $35,000. So essentially what the traditional cost approach says is add the dividends plus your cash value. Now the cash value is the actual number at the end of 20 years. There is no time value money there. It is a future value number. The dividends, though, is over time, so there should be some time value there that we're not making an adjustment for. But essentially, you received $46,000 from the insurance company, and you paid premiums of $43,000. After 3 years, you received $31.59 from the insurance company, but you paid premiums of $65.61. So after 3 years, your net out of pocket of $3,402. After 20 years, you've actually gotten more back from the insurance company than you paid them. If you were to surrender the policy today, you got $10,000 in dividends and you get your $35,000 cash value. You essentially got your insurance for free, ignoring the time value of money. Now we do that per 1,000. So we have 100, 100,000, 1,000. So it's a $100,000 policy. So 100,000 divided by 1,000, there's 100 of them. So the net cost per $1,000 is $34. But we also want to look at it on a per year basis. So on a per year basis, we just take that $34.02 and divide by 3. And so you can see on average, this product has cost you $11.34 per every $1,000 of insurance. Over 20 years, per year, you received $1.32 for every $1,000 of insurance. So your net costs divided by 100, not by 1,000, but by 100. We want to know how many thousands there are in 100,000. And then divide that by 20 years. And what you can do, and magazines like AM Best and others actually publish these numbers. And I find them really, really helpful, especially when we do net surrender. They're really helpful to compare companies across different companies and look at them over time as well. So let's look at the better approach, the interest adjusted net surrender cost index. Here what we're going to do, you notice the dividends are now 200. They're not, before we said 196, but here we can see they're 200. Why? Because we're going to a future value. What would that 196 have been after 3 years if we could have made 5% on them? And that $10,000 in dividends, if we could have made 5% at the end of 20 years, it would have been worth $14,000. You'll notice if you go back to the previous chart that the cash values are exactly the same. They did not change. Why? Because these are already future values. So at the end of 3 years, this is what you would have. The dividends, if you had taken them and invested them at 5%, you would have had $200. At the end of 20 years, you would have had $14,000. So here's what you would have received. Then we do the same thing with the premiums. What if we future value the premiums so we know the true cost in future value terms? And when you do that, the premiums are much higher when you raise those premiums at 5%. So now your net cost is actual cost. And then you do that per 1,000. So you divide by 100 because there's 100,000s and 100,000. And then you're going to do it on a per year basis. When you do it on a per year basis, you can't just divide by 3. You have to use the future value interest factor of annuity. Hopefully you remember how to do that. And that's 3.3101. When you do that, you get a net surrender cost index of $12.31. That's essentially the net cost per year per $1,000, and you can compare that to another company's. Over 20 years, it is better, but it's a positive number. It's not a net negative. So here it looks like you're getting paid to buy the insurance. But when you adjust for the time value money, it is costing you $7.46. This is a great number to compare. Now, when you buy a policy, this is the passage of time. So there's 2 ways you can get this with insurance companies. You can get an illustration where they show you what they think they're going to be doing going forward. But what I like what AM Best publishes is they show the actual historical numbers. Now, the historical numbers you cannot get. That's somebody else's product that they bought 10 years ago, 20 years ago. However, what I really love about AM Best is they'll compare companies on their illustrations and they'll compare them on their actual experience. Now the rules have changed on this. The regulators have changed the illustration rules, so it may not be as bad as it was when I was looking at this. But what was really fascinating is the firms that were #1, they had the cheapest product on the illustrations, on their forecasts. Those firms fared horribly when you look at the actual experience. That's one thing with USAA. USAA on the illustration, they were in the middle of the pack. They didn't look all that competitive. But when you looked at their actual experience, they were using the top 5 of all the companies. And that's because their illustrations were honest and their illustration reflected what they actually thought they were going to do. And so at the end of it, the companies that had these illustrations that looked way too rosy, their actual experience was much worse. So if you're looking for a company, I think that is a great place to look for a company to see if you can trust them. Their illustrations bear close approximation to what they actually experience. So yeah, that's available. I think the UTSA library actually has had AM Best in the past, so you could look that up. All right. So that sets us up for this term versus perm. So back one more time just on this interest adjusted. It works really well for comparing 2 whole life policies. It doesn't work well with universal life, doesn't work well at all with variable life. So this is pretty limited to just a few products. But as another good reason to buy whole life is because you do with the whole life have a way to look at just about everything that impacts the product, and you can get a good way to compare a company over time. So let's start this debate of term versus perm. We won't be able to finish it today. It might take all of this, the rest of this class and all of next class. We'll see. But this debate got very, very heated in the late 70s, mainly because of this gentleman here, Art Williams. He came along and he preached. Now, he didn't create this term. He actually worked for some companies that were preaching this. He just did it much better than everybody else. But buy term and invest the difference. We're going to actually do that here probably next class and show you the actual math, real life math. So we know permanent insurance is more expensive than term. So what if you buy the term insurance and take the savings and premiums, which can be really significant? You'll see in our example, it can be $1,800 a year. So you buy the term for $700 a year, and that's going to be $1,800 cheaper than the permanent insurance. So you'll take the $1,800 and you'll invest it. And then when the term runs out, you'll have all that investment money to provide you the protection you need, and you no longer need the insurance. So that's what he argued. It was revolutionary. Art Williams created a company called Primerica. You may have heard of Primerica. Travelers bought them and I think spun them off again. I know Primerica because my high school government teacher sold Primerica life insurance, and he actually tried to sell us insurance in his class, which I thought was pretty unethical, but he did. But what Art Williams did is he just got normal people, firemen, teachers, nurses, doctors, well, maybe, I don't know, probably kind of mid-income people who wanted some extra income. They would stick with their current job and they would sell Primerica insurance on the weekends. It had a multi-level marketing feel to it. It's not necessarily, it wasn't a pyramid scheme, but it somewhat in the way they did the commissions, it did have some of that feel to it. He really caused a lot of trouble for this industry. The industry never sold much term because it made so much more money on whole life insurance. And so Art Williams comes around and it really does get people thinking. It didn't make term take over as the dominant product, but it definitely grew much faster than perm during that time. So the industry tended to just market permanent insurance and said term was just, very unique. Very few people needed term, and Art Williams completely turned that around. Now here's a quote I found in Wikipedia. It said Art Williams and 85 associates that created this firm with buy term invested difference. He convinced customers to switch from their whole life to term. They had very rapid growth, became one of the largest sellers of term insurance in the country. But his real strength was his sales force. And the reason I say that is, I hope I'm not stepping on toes. If anyone in our class works for Primerica, it's a very different company today than it was at its founding. But their premiums were much higher than their competitors. That's why I said with my brother, they were charging a lot more than my brother was getting charged by State Farm. And State Farm is not necessarily the most competitive out there. So their premiums were much higher, and they had to be because they were paying really huge commissions. And so they had to charge a whole lot more. Not only that, they were doing the invested difference. And the invested difference, I saw the products they were selling. They were these very high front-end load mutual funds at the time. Just terrible, terrible products. So the argument I liked, buy term and invested difference, I did not like the company at the time that set this up. In fact, A. Williams had some serious legal issues. I think what's interesting is I used to be able to give you an update on his legal problems. All of that seems to be scrubbed from the internet. Wikipedia has cleaned up A. Williams. The Wikipedia I've looked at in the past, they actually had a section you could click on his legal problems and his prison term. That's been completely scratched from Wikipedia. I don't know why. But anyway, he's been cleaned up on the internet. He had some definite legal issues. And the company itself has had some issues with just some of their products, whether they're really a good deal for the customers or not. But it's his sales force. He would contact with them. Weekly video conferences, which back in the 70s and 80s, that was a huge deal. 100,000 plus agents. I don't know if you've seen some of these conferences of these multi-level marketing places. They feel like they're like pep rallies, and he had that kind of following. His salespeople were big believers. So his company became Primerica. I think the reason they were purchased by a larger insurance company, Travelers, is to get their hands on that sales force because they were really good salespeople. There's a New York Times article way back then when he became famous and gotten really, really known. I think this is before his legal issues. So the savings portion of the policies, that's the cash value. Williams says that returns have historically been low, and that's true. That idea that Americans need a forced savings, and we're going to talk that term, forced savings plan, with the insurance is the stupidest argument in the world. I don't think it's the stupidest argument in the world, but I do agree with him that it's a weak argument. There are consumer advocates and experts that are on both sides of this argument. We're actually going to be doing this argument here. I'm going to set it up. He says consumers are better off buying the cheaper term and investing the difference. I agree with him on that. I disagree that they should do it with him because his products I thought were really quite horrible, but I do agree with them if they invest a difference, and we'll get into that issue. I forget where I saw this, and I probably shouldn't quote it, but I just remember reading this, probably coming from an enemy of AOM, so it might be exaggerated, but that the majority of people buying term and investing the difference were buying term and spending the difference. They were not investing the difference. So that's an issue that we'll definitely get into. All right, so here's how we have to do it for the exam. So this is tough. You need to take really good notes during this time. Let me set up how I'm going to do this. And I'll walk through the high-level arguments, and then we'll go back in next class. We'll go into detail, and there's a few parts of this. This is one of those places where I'm going to cover everything. I'm going to talk about it, so you'll have to take notes. I want you engaged, so that's the reason I don't have it all just typed out for you. This is outline form, but you need to put it in much more words. So you have an exam question. I'll ask you to put this. You can't just do the bullets. You need to actually write out what I say. So if all you have for the exam is what's in these notes, you're not prepared for the exam. So be ready to do some heavy writing. Fortunately, you have the video. I'll try, I'm trying so hard not to talk fast because I'm a fast talker. Just normally, I'm going to try to even slow down more during this section. But what I did is when I built this initially, it was much easier back then because it was closer to the time this argument was being made, is I went out to Primerica's website and I got all of their arguments for buying term and investing the difference. And I put them down. You'll notice in a few places I give a counter argument to their argument just because I want to make sure you're ready for the next set of arguments on the other side of this. And then what I did is I took the arguments for permanent insurance. I used to use a textbook for this class. It's not a textbook I like, and the reason I don't like the textbook, it was very biased toward permanent insurance. Whoever wrote that book must have been a sales agent and loved permanent insurance for the high commissions. And so he, insisting in that book, argued for buy term and not buy permanent. Buy permanent, don't buy term. Very biased argument. So I just took his arguments and put them in here and listed them. And with him, I took his argument, I gave the offset to it. And I have more offsets to his arguments than I do in the term. I agree with more of the term arguments than I do with the perm. Let me give you the high level, and then we'll get into them in detail. The first one is, why mix your insurance decisions with your investing and savings decisions? Separate them. Secondly, term is cheaper, and it's cheaper when you're young. That's when you need insurance. You'll have more dollars to invest. The question is, do people actually invest the difference? You have more control over your investment program. We'll talk about some of the counter arguments on the other side. And this is number 4 to me is the weakest because of the unbundling with Universal Life and variable products. Really now, the insurance industry with mutual funds, you've got a lot of control over your investment program, even with the permanent insurance, especially with variable insurance. And there's a lot of trained investment firms. So people arguing against it and saying people can't find trained investment management. There definitely are. So, some of these arguments are old because I got them several years ago. I just want to show you the arguments they were making. Another one is you front load the insurance to the time you need it when you have dependents. It's simpler. This is actually my favorite one of all. You can withdraw funds. We'll talk about withdrawing funds. This argument actually has 2 sides to it. For both sides have an argument to make. Insurance pays very low rates. Again, Universal Life and variable products have somewhat been the insurance industry's reaction to that argument. If you insure your entire life, you're supposed to be insuring human capital. You don't have human capital once you retire, so you're buying insurance when you don't need it. So again, we'll come back into this more detail. I just want to set it up so you're ready in your notes. The argument's for permanent. He argues the reason insurers pay low rates is because it's lower risk. We'll get into that argument. If you live too long, you may need insurance later in life. And my parents are in that situation where if my dad passes away, my mom loses his pension and they need that insurance. And they did not invest the difference because they have almost no investments. This management and investments, that's the argument that's the weakest today because what's happened to the investment world. Borrowing against the policy, we'll talk about that. Here's one place where I actually think permanent insurance has a stronger argument than buy term and invested difference, but we'll talk about that. To me, the strongest argument on the permanent side is this forced savings, and we'll talk about that. But we'll have to talk about this in terms of the unbundled product, because the forced savings argument is weaker now with universal life, given that the insurance industry is no longer forcing that savings element. They're allowing people to avoid the savings element. And again, I kind of had these out of order. I should have combined number 2. You really should put number 2 and number 6 together. I did this in the order that he put them in the book. So insurance gets obviously very, very expensive after age 50 or 60, and so you may be out of luck. So that's the first part of the argument. The second part of the argument are these graphs, and I'll walk you through these graphs. The key on these graphs, I want to explain them today, so don't worry if you leave this class you don't understand them. But the key on this is in your exam answer. You have to fully explain why this chart does this. You have to explain what the axes are. And that's not in the notes anywhere. This is another place where I want to make sure you are engaged. I will explain them, and you'll have to take good notes and understand them. So I don't want you just to copy and paste what I say are the answers. So we'll be doing this, walking through this whole thing next class. But you got a good introduction. You see where we're going. Also, very valuable for you. When there's a good chance you'll have to make this decision about buying term or buying perm. And I do think there's an argument for perm in certain cases, like with my parents, but I think most people are better off with the term. So we'll leave it there right at an hour, and be ready for a good discussion next class on this.